everybody. I am Caoilfhionn van der Walt. I am the managing partner of Regan van Rooy, an African-focused boutique tax advisory firm. And we're very excited today to be looking at another exciting, fast-moving region of the world, being Latin America. So I'm honored to have as our special guest, Kersman from Argentina. And what we're going to be looking at is the key tax challenges and intricacies of trying to do business in Latin America and sharing our experience on the African side. We know this can be quite a heavy going topic, so we'd love to have a fairly interactive session. So do please come in with any questions in the chat. I'll monitor those as we go. And anything that you'd like us to cover, you can feel free to raise a question now. So Joaquin, I will ask you please to introduce yourself and tell us a little bit about your firm.
Thank you very much, Caoilfhionn. It's a pleasure to be here with you and with all the attendants. My practice, I'm a tax lawyer. I'm sitting in Buenos Aires, and we have a firm called LatAm Tax, which has a regional reach, which in similar ways to what Caoilfhionn was describing with regards to her own practice. There are many things in common between our practices where we intend to help clients throughout the entire region, based on our experiences on finding it a bit difficult to have this kind of support in our regions. So having said this, my team is basically formed by accountants, economists, and lawyers who are specialized in tax and foreign trade. And we have associates in the different countries where typically our clients need help. And we are supported by a sister firm, I would say, called Latin American Legal, which is basically the one that takes care of all non-tax issues. So having said this, I will, if you agree, Caoilfhionn, I will show my screen now and our presentation. And we can kick it off. Please feel free to interact through the chat as topics come up. The idea is to hear from you and to have your feedback during the presentation and your questions whenever you consider appropriate.
And guys, Joaquin and I have spoken a few times over the last few months, and I think we're both very interested, or we've got very similar views of the unique challenges of our jurisdictions, where there's a lot happening, a lot of complexity on the tax front, and not just on the tax side, on the legal implications of setting up a business. And both Joaquin and I come from a background of tax consulting, but then also in-house work. So I think one of the things that I love about working with you and your firm, Joaquin, is the focus on practical advice and real answers, which often in these more kind of complex jurisdictions can be hard to find from kind of standard advisors. So I'm looking forward to our practical and hopefully helpful discussion today.
Great. Thanks a lot, Caoilfhionn. So I'll kick it off, and please let me know if there are any comments or questions, as I probably won't be able to see them here.
And maybe you could start, Joaquin, with a kind of high-level overview, if you can, of what are the biggest tax challenges that you think face a business trying to operate in the Latin American region at the moment.
Okay, definitely. So let me kick this off. Great. So you were asking about the biggest challenges in Latin America, and I think Latin America has typically been the region where doing business isn't easy, especially for foreigners, where there is a lot of bureaucracy, and in general the tax systems are very complex, differently to maybe other more developed regions. The income tax is not maybe the only concern or one of the major concerns. There are many local taxes which impact your business. So in general, I would say that structuring your business correctly in Latin America and eventually planning not only internationally, but also domestically on your structure is key for the success of your business, and it can make a big difference. And we'll have a look at some examples throughout our presentation in that regard.
And that's
This is our
definitely the same case in Africa. We say that often African taxes hurt you where you least expect it. There's different types of tax that come up that apply in different ways, or maybe a tax that you're used to being very small, like for instance, transfer tax can be very material in Africa. So again, the key is to make sure you structure properly upfront rather than find out about these things the hard way.
Absolutely. And what we're seeing in the last couple of years, and especially nowadays, is that tax authorities are trying to attract investment and collect as much as possible from these investments, especially given the difficulties in collections that we're beginning to see in the region as a consequence of the high interest rates worldwide. So they're being very creative and quite aggressive. So we'll have a look at this as well during our presentation. These are the topics for today. We'll go through them high level. The idea is not to get into the details and to try and include as many important topics as possible. Feel free to ask and interact. Well, this is a bit... Yes, Keelan?
No, sorry, I'm saying great, looks good. Some meaty topics to cover.
Yeah. So this is interesting to watch because here we can see the corporate income tax rate, nominal rate, and we can confirm what both Keelan and me were saying, that Africa and Latin America are definitely among the regions where we have the highest rates. And I would reaffirm this by saying that the effective tax rate is generally much higher than the nominal tax rate in our regions. So this is one of the major concerns, especially for multinationals doing business in the region, which is of great interest from a business point of view for most of the multinationals, but they encounter these difficulties when doing business in our countries. This is an example to start off. So this is what we were talking about, and most of you who probably know the regions well feel identified. So this is a local company, and it's a company that typically has started business rather recently, let's say 5 years ago, and they have grown significantly, exporting great part of their business outside their original country. But today they face these kind of problems or issues. No, they have lots of foreign exchange restrictions on exports, meaning that when they export their products, they need to repatriate the funds and convert them into local currency. There are exports taxes. There is a high tax on revenues, especially income tax, 35% in Argentina, as an example. Generally, that's the rate average for the region. They have difficulties in importing given foreign exchange controls. So basically, they're not given the US or hard currency to be able to pay for their imports. They pay dividends tax. They're subject to capital gains tax if eventually the partners sold their shares or their intellectual property, which all lies within the same legal entity. And there are high operational and transaction costs, as well as an inefficient structure for investments by eventual interested parties. So remember this case, because we will look into some alternatives that were handled to resolve the situation and how this ended up. But it's just an introduction for you. You're probably thinking, well, it's the same in Nigeria or maybe in some other African country. I would say that this structuring is very typical, where Latin Americans tend to kick off the business and then worry about the planning and the structure. Basically, here what we see is that this Argentinian company basically kicked off the business and they grew very fast. They're exporting 95% of their production. So they manufacture, they hold the IP, and they export all from the same legal entity. They're owned by some local partners plus some international investors, and they have local clients 5% and foreign clients 95%. So this structuring is definitely inefficient under local foreign trade and tax rules for the reasons we see on the right side, which are basically the ones that this client was very concerned about. Not only on the operational side, but they were planning to have investments rounds, and they were worried about the fact that their capital gains tax or their dividends tax were very high in Argentina and in general in the region. So they were looking to restructure before it was a bit too late. So we'll look into the alternatives in a while, if that's okay.
Yep. But again, the issue is structuring upfront is the best thing to do. It can be any restructuring afterwards is more expensive, more complex, leads to various tax issues, particularly capital gains tax.
Absolutely true. And what you say, Caoilhionn, is important because in general, Latin Americans, they tend to plan after they've done business. So,
yes, same in Africa. Yeah, no, we're well used to that type of issue.
okay. So now let's look at it from a multinational's point of view. So let's imagine we have a multinational group which does business in Latin America as a whole in different countries. So here we can have a quick look at the high level picture on the effective tax rate. So the group, great. So now we're looking at, as I was saying, the effective tax rate for a multinational group doing business in Latin America. And we see clearly that the IBT, the income before taxes, for the group as a whole is 1,000 currently. The tax expense is 350. That gives them an effective tax rate of 35% as a group. Now, in Latin America, we see they're losing money from an IBT perspective, but they're still paying income tax. How can that be? Well, that's basically because of the local adjustments and rules that make their local subsidiaries add up these 30 local currency amounts in tax expense. So the first reaction the CFO might have to this is the bottom line, which we see quite usually, where the conclusion is, okay, if I did not have Latin America in my business, I'd be in a better IBT position, I'd be in a better tax expense position, and my effective tax rate would be 30.4 instead of 35. So that definitely makes them think, first reaction is, why don't we close business in Latin America? And luckily there are many things, many additional topics to it, like not only tax issues, but this would typically mean that CFOs and maybe even CEOs are asking, okay, how do we reduce our effective tax rate in Latin America? Is this something similar to what you see, Caoilhionn, in Africa?
Yeah, I mean, that was quite stark, that example you showed, and how looking at the picture without Latin America looks better. I think we do have similar issues here. So I'm very interested to hear what the main effective tax rate drivers are in Latin America, because I think they're going to be similar to what we have across Africa.
Okay. Are you seeing my next slide now?
Yes. Yep.
Great. So basically, these are some of the main drivers. These are the typical drivers that local regional managers look into when they need to reduce the regional effective tax rate. One of them being the corporate income tax losses and their valuation. It is quite common, especially in the example we're seeing, where Latin American subsidiaries were losing money, that they find themselves in a CAT loss position. In general, in Latin America, you can carry losses forward, but you cannot carry them back.
Exactly.
And the carry forward period is generally around 5 years. So it is quite usual that there is a valuation of these losses for multinationals, and therefore they are considering a hit, which they would only recover in the case of profits. And this is something that one should look into, know if the valuation has been correctly assessed. Then the other topic, which we were discussing with Keelan, and it's interesting in Latin America, is, I would call it item 2 and 3, where there are many permanent items shown in financial statements as non-deductibles or intercompany charges that cannot be deducted by local subsidiaries. And this is based on local domestic regulations and limitations. Typically, an example would be that you cannot deduct your exchange losses for inflation. And if you have a country like Argentina, where you have, or you had 200% inflation in 2023, and you cannot deduct the losses deriving from the devaluation of your local currency, well, there you have a tremendous permanent item to acknowledge. Plus, countries like Brazil, which do not permit the deduction of intercompany payments for royalties, trademarks, technical assistance in excess of 1%. This is now being revised by Brazil, but it's only an example. In general, you have these kind of limitations in all Latin American countries.
And that is very onerous. We spoke last time about how various African countries have brought in kind of guidance about connected party payments, and often on royalties and similar intangibles. But usually it's not enshrined in law, and it's more at the subject of a transfer pricing audit. So it's quite harsh that many of these countries just disallow them completely, particularly when globally they'll be required from the counterparty's company tax jurisdiction to charge an arm's length royalty.
Absolutely, absolutely. It is a big headache, and in general, you need to find creative solutions, because sometimes a typical rule in Latin America is that while you do not pay intercompany charges, you cannot deduct them locally. So if this goes in hand with foreign exchange controls under which you cannot make payments to related parties, given the lack of US dollars available, maybe, you find yourself in a position where you cannot pay and you cannot deduct.
Yep.
So what companies have done in some countries is capitalize those intercompany concepts, and this is treated as a payment, and basically they get the deduction. That's an option. The other option is a simple write-off, because many times the foreign parties need to write this off, considering they have done so from an accounting perspective already, and it makes no sense to keep these intercompany charges.
Yeah. So your deferred tax calculations are quite complex across Latin America.
Very, very. And that's an enormous world where, yes, many times the foreign teams in multinationals need a good support locally, in-house and externally, and it's not that easy to find. And it's not that clear who's responsible for this, if it's the accounting team or the tax team, but that happens to us.
Deferred tax is one of those issues that often falls between the gaps.
Absolutely, yeah. So last but not least are the audits and tax assessments and their provisions, obviously. Latin American tax authorities can be really creative and really aggressive when it comes to audits and tax assessments. And where they're especially focusing on nowadays is transfer pricing. So I would say Mexico is number one in this sense. And you can have a very difficult time because they have a process, a long process, which is called acuerdo conclusivo, during which you can negotiate with tax authorities and reach an agreement. But in general, they are very, very, yes, keen on assessing a certain amount. And they start off by saying, we basically disallow all of your intercompany deductions. That's our position. We
Yeah,
don't consider them in the
sounds
third world.
sounds very familiar. So also across Africa, tax authorities are very aggressive and very in many cases very well trained, particularly on transfer pricing matters. And similarly, their intention is often assess first and kind of argue over many years. So that was very interesting to see how the effective tax rate is generally made up. Can you give us a bit of a summary of the current tax environment across Latin America, what trends you're seeing?
Definitely. And let's have a look at this while we do so. So Latin America is probably one of the regions where tax authorities invest more heavily in technology and access to information, and they are definitely in agreement with any kind of exchange of information they can lay hand on. And we can see this in the examples we're watching here. Like Brazil has 40 federal tax reports, which are due every month. And Chile has 50 annual informative electronic returns. So Mexico, for example, has an independent certification by the auditors, and they call the auditors first when there is an assessment or a tax audit. They speak to the auditor and then they call in the corresponding taxpayer. So we've began to see already some time ago that real-time tax returns are prepared by the tax authorities and sent to taxpayers for them to consent or disagree. But that's where we stand today. Adding to this, there are tax reforms in average in our countries every 2 years.
Yeah.
So you see a huge tax reform every year in our region. Brazil is now undergoing probably the greatest. They've incorporated OECD standards for transfer pricing. They're amending their indirect taxation system, which was basically a nightmare where you had states competing among themselves and companies doing business in strange ways to lower their local taxes. So all of this is happening, and it's happening fast in the region. That's a bit the picture.
Very similar to Africa. And of course, I'm not sure if you see this, but often people who are coming into Africa, they do think of Africa as, one homogenous region. And there's so many different jurisdictions that have got very different rules and regulations and processes. And with so much happening in so many countries, it's very hard to keep abreast.
I can imagine. It's very similar to what happens here. And there are similarities among the countries, but also there are very, very different situations.
Yeah. Wow, look at this graph. That is quite scary.
Yeah, this is it. I like this graph because you can see that in international tax issues until the 2000s, basically most cases related to OECD countries.
Yeah.
By the way, in Latin America, we now have Mexico, Chile, and Colombia in the OECD, but this has happened in the last, I'd say, 10 years.
Yeah.
And as of the 2000s, we see that the BRICS and the developing countries have more and more international challenges and cases among the ones in dispute. So this has grown drastically, and we can definitely confirm that Latin American tax authorities are focused on these cases. They would typically come after the multinationals and after their intercompany transactions, as an example. So this is a chart which I like because I showed it once to my Adidas head in Germany. We had a structure where we had German and Dutch companies in general, and they were believing there was no exchange of information between Latin America and these countries. So basically, I was showing them that all of the countries involved, or where there were subsidiaries in Latin America, were exchanging information with both Germany and the Netherlands under double taxation agreements, taxes for the exchange of information, or the CRS OECD multilateral exchange of information agreement.
Yeah, and we're seeing this more and more. We actually wrote an article last week, I think, called Nowhere to Hide. And it's just, we tell people all the time, if you try to hide anything, it just can't work anymore. The exchange of information, the access powers that all tax authorities have is immense. And you said that Latin America is focusing a lot on technology for accessing information. We're seeing the same. And with how much technology is increasing every week at the moment, I think the powers of access to information that all the tax authorities have is astounding.
Yeah, yeah. And I tell you now, the following round is they're investing in how to order all the information they already have. Like they had so much information they couldn't handle it.
Yeah.
So now they're investing to see how they put this in order and they come after the cases they consider important.
Yep.
So as a consequence of all this, it's obvious that audits and assessments have multiplied significantly. And we won't lose too much time here, but basically, sorry for that, there are a couple of issues which are important in our region, and there might be similarities with Africa, I believe, where voluntary disclosure of tax deficiencies is maybe an option that one must look into, but there are many concerns around it, like other fiscal years, benefits, recognition of criminal consequences. It's not easy to negotiate
Yep.
and get to an agreement with tax authorities. Sometimes there's not even a process in place for this to happen. There are amnesty programs and installments alternatives happening basically every 2 years average. So this is something companies should consider. So as I always say, litigating in Latin America is bad business. It's not recommendable, but sometimes you have no option when they come up with crazy ideas. So here I've summarized the pros and cons of litigating in Latin America. And this is obviously something that can be extended, but basically we see that among the pros, you can go to an independent or more independent parties review, meaning justice. You can defer the payment, which can be a big difference given the devaluation of local currencies. Yep. There's a non-recognition of the tax authority's position, which is important sometimes even for the directors involved. So you're in a better position for any criminal proceedings, and there might be an amnesty, which usually happens. Litigation costs are very high on the con side, interests and penalties as well. The tax payable is generally due before the final decision, and if you have to pay and you will recover in 10 years' time, it stops being an interesting alternative maybe. And timing cases in Latin America can be very long, no? Up to 10 years is something not unusual. And last but not least is the political and reputational consequences for the company, which means if you're willing to fight against the tax authority, you must be ready for the consequences. And consequences can mean different things, such as tax authorities coming into your offices, looking for information. They need certain approvals for this, but this happens in our region. So those are the scenarios we generally have to manage. Is it similar in Africa?
Very similar. I'm just nodding my head with every point. And I think all of this tied in with the aggression of the tax authorities means that tax managers have a very difficult job because, if all of a sudden you get an assessment that you weren't expecting and they might require you to pay upfront with, maybe a 10-year horizon for the court case, it obviously is not something your CFO will be happy about, but often these risks are very difficult to quantify upfront. So I think what we often recommend for Africa is, again, it's structuring carefully upfront to make things as safe as possible, and also to conduct regular tax health checks. So look at what's going on and where the kind of weaker elements of your transactional structure might be, especially bearing in mind the specific cases that are happening in the various countries. But it's a very difficult juggling act. I must say, I'm glad I no longer work in an in-house tax role.
Yeah, I fully agree, Keelan. It's exactly the same here, and I feel the same. Okay,
Yeah, so this
so
is an interesting discussion, and I often find that working in, a so-called developing jurisdiction, there can be a perception from, let's say, the tenets of international tax that we're not as sophisticated in our regions. So I find it very interesting how Africa and Latin America have taken on the various global taxing initiatives, and in some cases they're actually pursuing them more aggressively than in other countries.
yeah, it's interesting because I believe there is a small portion of our tax authorities departments that are very involved in these topics, and they do have a position in that regard. I think that position, at least my impression on the Latin America, I'm going to the conclusions directly, but my impression is that Latin Americans are cherry picking the rules according to their convenience, and
Yeah,
they're waiting and seeing how things develop. That would be
yeah,
basically the two things they're doing. And this has been, I think, very convenient for them. Like, let's take Brazil. Brazil is the first country in the region that has incorporated a QDMTT rule, basically, under which there's a minimum 15% tax, but it's the only rule they've incorporated. And all other countries have not done this because, in general, the minimum tax standard is met. It's very
yeah,
difficult to find a country where you don't pay 15% in the region. So it doesn't make much sense for them, except for maybe Uruguay, which has special rules there. So that's a bit what we're seeing. And Latin America has also learned from past experiences, typically the exchange of information regimes under CRS versus FATCA, where they are maybe in the middle of Europe and the US with their different views. So I think they won't move forward until there's a clear picture ahead. And that's a bit the scenario. This gives rise to a lot of uncertainty. Multinationals
yeah,
still have to do their assessment on an annual basis, especially as of 2024, with many European countries already having Pillar 2 in place. And in the meantime, taxpayers and practitioners are having a rather tough time because basically they still have to comply with international rules, which are very different from domestic rules, which they also need to meet. And this gives place to a lot of uncertainty, and ambiguity, I would say.
yeah. And uncertainty is just the worst thing when you're trying to manage a tax function, and it's the thing your CFO least wants to hear. So yeah, it's not an easy situation.
Yes, no, definitely. So typical example of this could be many multinationals had their regional headquarters in Panama, where you don't pay any local CIT, corporate income tax, and you do not pay for your foreign income as well. But basically, they were not being able to deduct their expenses in these headquarters, where the employees were very happily living because they don't pay personal income tax either. But on the other hand, now they find themselves in a position where they need to resolve the minimum tax issue, the Pillar 2 15% tax. So some of them are closing maybe their headquarters regionally, or finding different alternatives, or passing on expenses to operational subsidiaries, those kind of situations. But it's an example of what's happening. Good. Are you still there?
Yeah.
No comments on the chat so far?
No, guys, please do jump in if you've got anything to add, any questions. We know we're covering some quite heavy topics, so it's always nice to get some interaction from our listeners.
Okay, so let me go through this really quickly. Basically, Latin American tax treaties and international tax rules are based on source principle, where foreign parties are subject to tax if they obtain locally sourced income. This is the same principle followed by their tax treaties, where Latin American treaties in general are more towards the United Nations model tax treaty than towards the OECD model. And this is especially seen in passive income articles such as Article 10 on dividends or 11 on interests, where the residence country has primary the primary option to tax, but the source country, typically the Latin American countries, can tax up to a certain amount, a cap,
Yeah.
which is lower than the local rule, but generally relatively high compared to international standards.
Yep.
So this is
And
very
does that typically apply on services as well, or just dividends, interest, royalty? Well, royalties, I guess, doesn't count.
That's a very good one, because in general, services are included in the royalties definition when they consist of technical assistance or there is a transfer of know-how, while non-technical services would fall under Article 7 and therefore would not be subject to source taxation. So this is very usual to plan around, where you can have a foreign party with no PE in the region obtaining non-technical services and not being taxed in the corresponding countries.
Okay, interesting. So what we often see in African countries, and I'm excluding South Africa, which has the most developed tax regime across the continent, but we often see is that services are ignored in that they're not specifically covered in the double taxation agreements, which means that the source country generally cannot tax them, but that is ignored in country and a high withholding tax is applied, often 20%. And I think this is your point about the source taxation, even on dividends and interest, is often quite high. That's a good point, because often a business investor, let's say from Europe, they don't even think of a high withholding tax on dividends or interest if there's a DTA, because in their experience, it's generally low. But in Africa, and it seems also in Latin America, those amounts, even as reduced under the double taxation agreement, can be significant.
Yeah. And this also drives your effective tax rate, no? This is another additional point.
Yeah.
Great. Okay, so this is an example on the deduction method, the exemption, and the credit method. We won't look into the details, but in general, the method we use in Latin America is the credit method under tax treaties and local regulations. So that would end up being an in-between solution between exemption and deduction. Treaties in general follow international standards. There isn't anything too strange there, except maybe for the services treatment that Keelan was referring to, and that other income, Article 21, is generally in favor of the source country, meaning that other income not taxed specifically can be taxed at the source level under tax treaties. The multilateral instrument is in place already in some of the Latin American countries, not many of them, but Mexico, Chile, and Uruguay already have the MLI in place. This implies some changes to existing tax treaties, which have been included in the position of these countries, but more specifically, it includes the anti-avoidance rules, such as the principal purpose test and yes, some others where basically the tax treaties are subject to these limitations on planning, And this is important to consider when you do business in those countries where MLI is in place. Other countries are planning to incorporate MLI in the short term, so we should see this probably soon in most of the region.
And are you seeing a good understanding by the taxation authorities of the MLI and what's that going to, how that is going to impact the double taxation agreements?
To be honest, I have not seen them understanding this too much, except there are exceptions. And many times even tax practitioners or in-house tax teams do not take into account the MLI.
Yeah, I
And
agree. I agree. It's a whole, I mean, it changes everything. It can change the entire DTA framework. So yeah, another thing that adds uncertainty to our tax lives.
absolutely, yes. So I always tell my students at university that if they become experts in MLI, they have a big advantage already because this is new and few people know it. So
Yeah.
it's important to bear in mind. So some planning strategies, and let's look into, remember the original structure we had talked about the Argentinian company and all of its problems. So this is an alternative they handled and they ended up implementing. So you can see there on the far lower right, the Argentinian company originally. So now the partners have incorporated above this operating Argentinian company, a holding company, where they analyzed basically two final options, one of them being a Spanish holding company and an LLC, a pass-through entity in the US. The main difference from a tax perspective for these two entities was that Spanish has a much better tax treaty network with Latin America than the US. Now, on the other hand, the Spanish holding company requires substance under domestic regulations, and the participation exemption rule only applies to 95% of its dividends and capital gains tax. Sorry, and capital gains. So that means there's a 5% subject to the 25% income tax in Spain. So basically, these were the two options. In this case, they preferred going for the Spanish holding company, given the treaty network and the certainty. Generally, Latin Americans feel comfortable with Spain.
Spain, yeah.
And then below that, you have a trading company, which basically would now buy the product from the Argentinian company and would sell to the rest of the world, to the international clients. This trading company could be incorporated in SEC, which means Canarias Islands in Spain, with the benefits of the treaties, plus a special regime of a 4% income tax instead of 25. Or alternatively, in Uruguay, where there is a special regime under which only 3% of your margin is subject to tax. So that ends up meaning a very, very low effective rate of around 0.5%. So here the client felt a bit more comfortable with Uruguay, although Spain looked nicer with regards to the IP company. Uruguay because it's closer and they know the rules, and then they felt more comfortable. And the IP company, we looked into the patent box regimes in many countries, but these were the finalists, and Ireland looked especially well. Keelan, I won't tell you about it, but it was
Ireland's always
especially,
great.
yes, it was chosen, in fact. So the IP was transferred from the Argentinian company to Ireland. The benefit is not for commercial IP, it's more for patents and scientific IP. And the IP company also collected royalties from the trade co. So basically this was the way it was funded. And all of these underlying companies paid dividends to the holding company, which was exempted from dividends tax and capital gains tax if eventually they realized or they sold any of the operational companies. And the good thing about these holding companies is that they don't pay tax on their dividends distributions to partners. So that was also a benefit. To round up, generally, when we look into these kind of structures, we do not get involved with the partners' taxation, because partners can be located in different places and they can change their residence, or there can be big differences. So we look at the structure underneath the partners, including the dividends being paid to partners, but not the partners' taxation. That was at least the rule here when we did this analysis. Good. So this is a different situation, which is very common in Latin America, and I believe it could be in Africa as well, where you have a local distributing company which belongs to a multinational group. This multinational group, its functions are split, as we show here on the screen, each of them having place in a different jurisdiction and legal entity, most of them happening abroad, and only local marketing and distribution taking place in Latin American subsidiaries. So as a consequence of this, you have an operating margin as a whole of X, and you need to split X among the different players involved in this structure. So what typically could happen, and in fact it did happen in this case, was that one of the tax authorities came into the local subsidiaries' books, I mean the Latin American distributors' books. This distributor was a full risk distributor, meaning that it assumed all the risks of its business. And they asked for this chart where the operating margin is shown compared to the interquartile range. And you can see that there were years such as 2009 or 2012 where there were significant losses, while there were other years where the distributor was making a big profit, such as 2016 with a 12% margin. So tax authorities were not happy with this. So the questioning had to do with 2012 and 2009, saying, okay, you're below the range, you need to adjust and pay the corresponding taxes. I don't care if you're paying extra tax in 2016 or 2010, that's your problem. So what happened next was that this group restructured and it incorporated a related trader in a jurisdiction that was convenient. And the local distributor was converted into a limited risk distributor. So basically, it did not assume some of the risks, such as it bought in local currency. It didn't assume the exchange rate risk. The importation was done by the related trader where possible. And this was a structure not only for Latin America, it happened globally, but it included Latin America. So local distributor, limited risk now, was buying the product with a markup which included all concepts in the price. It did not make any further intercompany payments or any other payment rather than buying the product. And the related trader would make all the payments to the related parties involved, brand remuneration, IT, services, all other concepts. And the manufacturer was selling to the related trader, which obviously sent the products directly to the different markets. Okay, so this was basically the new structure. The good thing about this new structure was that you would not show losses as the ones we see here. You would have an operating margin which would be average during the different years. You would not see big fluctuations, and this would not call tax authorities' attention. The bad thing was that probably the margin would be lower given its new function and risks. So you might need to explain the new structure to the tax authorities. In fact, it did happen in a couple of countries, and that was okay. There weren't too many issues. Now, There are some considerations to this structuring in transfer pricing, basically which is the margin we should allocate to the limited risk distributor. Should we indemnify this distributor for moving from a full function to a limited function? In general, OECD standards indicate we should. There are timing and potential challenges to existing and new structuring. This goes in hand with what we were discussing at the beginning. It's always better to do this from the very beginning and not mid-river, as was the case here. The customs impact was higher under the new scheme, basically because the product's price included all concepts, and therefore customs impact should be considered. I tell you, Brazil and Argentina were left out of this restructuring because their customs duties are very high. And last but not least, all of the documentary support to basically show this to the tax authorities, inform where due, and so on. So, Keelan, are you still?
I'm just looking at the time. We've got 5 minutes left. Don't we have any questions or comments from the attendees? Anything that you think we're missing in terms of our summary of Latin America? Any questions you have on what we've covered so far? Don't be shy, guys. You can just write it in the chat.
Yes, or maybe if you've had an experience in this sense, or you have any thoughts or any comparison to Africa, I'm especially interested in hearing, because we all learn from these. But if that's the case, please let me know, because I'm not seeing the chat here.
We've nothing in the chat, so hopefully that means everyone agrees with everything we're saying. So Joaquin, we've got 4 minutes left. I know you still have a couple of slides to go through, but can you choose whatever topic you think would make most sense to cover? And guys, we will be sending the recording of this session and the slides out, and both of our contact details are on that if there's anything you want to discuss with us further.
Thank you very much. Yes, let me show you very quickly, and I think this is an issue worldwide, but in Latin America, it's especially difficult to find good teams, tax teams, I mean, and to permit these teams grow as due, not only, I mean, collectively and also individually. So here I've listed a bit the differences between what usually happens, which I call the workhorse, and what should happen, which I call the legend. And I think it's very important today, especially in our regions, for tax teams to bear this in mind, because this is what internationally standards are looking into and focusing on. And it is no longer, yes, a good idea to fall within the workhorse scenario, which we all know many times happens because we all need to basically comply with the filings and the important things need to be done. But sometimes we need to look into some additional topics as the ones we see on the right hand. No? So we all have examples in this sense, but I think it's particularly important for the tax head to be part of the discussions on the business side, in the boardroom, to be very open to incorporating technology, have a holistic approach, and try to be a lot more business oriented than typically would happen in maybe in-house roles.
Totally agree. We have one question in the last minute.
Yes.
So, Joaquin, can you please elaborate if there are any specific developments reshipping income tax in the region?
Shipping income tax. Okay. So basically, I believe there have been no specific developments. Shipping is covered by double taxation agreements in general and specific transport agreements, tax agreements that are in place in Latin America and most countries. And I don't know if I'm missing something here, but in general, shipping only gives place to income tax when the revenue arises within the territory of the corresponding country. So many times shipping of products can be exempt or not subject to income tax in our countries if it happens outside the 200 miles sea limit for our territory. That is quite common, no? As we usually recommend it happening. So I don't know if that's answering the question.
And it's just coming up to the hour, so we will wrap it up there. Guys, we will send the slides and the recording, and our email addresses are in that. So if you have any questions, reach out to me or Joaquin. Joaquin, thank you so much for today's session. It was very interesting, and it's always very hard to cover so much in a short time. So thank you for making it nice and succinct.
Thank you very much, Keelan, and thank you everyone for joining. It's been really nice sharing, and I look forward to being in touch.
Bye, everybody. Thank you.
Bye-bye.
Bye.